Bienvenidos a Invertir como un profesional. Después de casi un mes y medio de no hacer directos, volvemos hoy con un directo muy especial, una entrevista a un CEO. Ya sabéis que no es sencillo entrevistar a CEOs. Por tanto, hoy hemos quedado con Marc Bishop, que es el CEO desde el año pasado de Ecora Resources. Entonces, la idea es un poco que nos presente la compañía de forma genérica. Ya sabéis que dentro del club de inversión la próxima tesis que vamos a presentar en detalle va a ser de Ecora Resources, después de la tesis que presentamos en Exatronic. Todas estas tesis van acompañadas de hablar con el CEO, pero sobre todo y más importante, contrastar la información, ya que creo que es un factor diferencial en la gestión, el análisis de este canal de YouTube, también en el club de inversión. Por tanto, evidentemente, en Ecora también vamos a contrastar esa información. El día 6 de junio vamos a hacer la tesis, ¿vale? Por tanto, yo creo que es muy interesante. Compañías royalties, ya sabéis que me gustan bastante. Pero, dado que ya hacía tiempo que no hacíamos un directo, estamos en la última semana del curso. De hecho, hoy hay clase después de la entrevista. También hay clase el jueves y el viernes y ya va a terminar el curso. Por tanto, probablemente a partir de la próxima semana retomemos los directos del jueves con un formato algo diferente, pero vamos a retomarlo. A ver si alguien por el chat me confirma mientras esperamos a Marc que se escucha todo bien, que se ve bien. A ver si alguien me puede confirmar, creo que hay gente conectada. Vale, repito, la idea de hoy, pues hablar con Marc, ¿vale? Veo a Luis Caicedo. Luis, ¿qué tal? Un clásico del canal, aportando valor también. Recuerda que yo también aprendo con vosotros. Al final, ya veo a Marc conectado. Al final, lo que yo hago con vosotros, pues yo también aprendo dentro del canal. Javier, ¿qué tal? Javier Soterino. Muy bien. Voy a dar paso a Marc. Marc, hello.
Hello, how are you, sir?
I'm fine, thank you. So first, thank you for accepting my invitation. So this is an idea because, as you know, the private investor, is it difficult to try to talk with the companies, with the CEO? So as a professional investor, I used to talk with the CEO. So 2 years ago, I said, okay, why not I'm trying to bring interesting companies and try to bring the CEO to the channel? As I know that private investors, is it difficult to ask questions? So well, thank you for the invitation. My idea is to make a general brief about your company and then make maybe 10 minutes for people that they can ask something. Let me, before we start, let me read the disclaimer, first in Spanish and second in English. And if you want to read something, feel free. So, Invertir como un profesional no ofrece ningún servicio de inversión, no ofrece ningún tipo de asesoramiento financiero. Cualquier opinión aquí expresada por mí, por el formador, o en este caso por Marc, es totalmente educativo y nunca se debe interpretar como una confirmación para comprar o para vender. Invertir como profesional does not offer any investment services, does not offer any type of personalized financial and investment advice, and any opinion or analysis expressed here by the instructors is always entirely for education matter and should not be interpreted as confirmation to buy or sell any securities. So let me, Marc, before I start, so we are, Ecora Resources is a royalty company. I'm going to ask you later that if you can explain in some words what means a royalty company, because maybe there are people that they understand what it means. So Ecora Resources is a natural resource company who is in transition from cool commodity to future commodities linked to the electric vehicle and other things like cobalt, copper, and these kind of things. So is it traded in, is a UK company, but trades in the UK, but at some time trades in Canada and in the US. It's a 300 million, more or less, GBP market cap company. So I think it's really interesting. So, Marc, let me start with some questions. So could you explain what is a royalty company?
Yeah, of course. And before that, just like to say thank you for having me here today. And I think it's a great initiative, actually, what you're doing to bring some insight and the conversations to investors who may not otherwise have the opportunity to ask questions. It's something that we love doing. So what is a royalty? Well, a royalty is a very simple instrument, right? A mining royalty entitles the owner, in this instance, Ecora, to receive a percentage of the revenue generated from extracting minerals from a defined area. So what does that mean in a practical sense? Well, the way to think about it is that when Ecora has royalties over mining operations and a mining company mines material, copper, for example, and then sells that copper, we are entitled to a certain percentage of the realized sale price. So as an investor, it is a very different proposition investing in Ecora to investing in a mining company. Because if an investor invests in a royalty company, their exposure is primarily to the production risk, i.e. how much material is extracted and when. And number two, the price realized for the sale of those commodities. A mining company will incur costs to extract those materials from the ground. And in today's world, we've seen some fairly substantial cost pressure and cost inflation. The royalty company, on the other hand, has a very small fixed cost base, and therefore the benefit of a royalty company is that there's more direct exposure to price and over time. So I'll give you an example. If you think of copper, 20 years ago, copper was approximately $1 per pound, in that range, plus or minus. Today, copper just under $4. So a royalty company would have seen, if they were entitled to 1% of the income, their income go up by fourfolds. Whereas a mining company would probably not have seen a 400% increase in the margin as a result of operating cost inflation. So the royalty model is generally, when you overlay a portfolio of diversified royalties, generally a lower volatility way to have exposure to a set of commodities and to the mining sector.
Okay, great. Let me ask before move to Ecora Resources, because you was CEO in last year. So could you explain a little bit who is Marc Bishop before going to be CEO of Ecora?
Yeah, well, for the 8 years prior to being CEO of Ecora, I worked at Ecora. I worked here in the investment team, primarily structuring, negotiating new royalty acquisitions. So I have a pretty long experience just doing royalty deals. And furthermore, the company is obviously much more than me as an individual. We've got a team of folks who are really experienced in the royalty sector. Kevin Flynn, our CFO, has been involved in this company for almost a decade. Our BD team, our legal team, and others, if you cumulatively add up all the experience, it's just under 70 years, 60 to 70 years of royalty and streaming sector experience, which is quite valuable because royalties and streams, structuring, negotiations, originations, all these things require a lot of just knowledge, familiarity, but also relationships in the mining sector.
Okay. Also, I thought that before going to the companies, you was working in Citigroup as a metal analyst. Right?
Yeah, if we go even further back in time, I've worked at Citigroup. I worked in their industrials team in sort of investment banking, where primarily I covered mining, natural resources. And one of the beauties of Citigroup actually is that there's opportunities to rotate laterally and spend some time working in other teams. I also worked in the leveraged finance team, which I didn't know it at the time, but it was excellent and incredible preparation for working at a royalty company, because royalties have certain equity-like characteristics, but of course have certain debt-like characteristics as well. And so we're very good background.
Most of the CEOs that I was talking for royalty companies, they come from large investment banks and leveraged buyouts, M&A or something. So they are not geologists. So do you think could be good to have some knowledge of geology, or do you think it's totally different because you are financing deals and this is the most important?
Well, I mean, it's not necessarily mutually exclusive. I mean, there are a lot of folks who are CEOs of royalty companies who historically have technical backgrounds. So who are at one point in their careers focused on technical things and then transition to being finance. I think it just comes down to the depth of the team. And my strengths are not in the basket of geology. Thankfully, we have a lot of support specifically on those areas. And generally speaking, because Ecora Resources targets a broad array of commodities, so for example, there are royalty companies focus primarily or only on precious metals. Our basket includes copper, nickel, cobalt, uranium, vanadium, amongst other commodities, and we look at others on top of that. And so actually, where we've had a lot of success in the past, and we plan on, and we would certainly hope that would continue, when we diligence opportunities, we work with third-party expert consultants who are experts in the specific projects of the specific geology of the specific commodity in that jurisdiction. So we generally are able to overlay a huge amount of bandwidth and knowledge and expertise without having a fixed cost, which is very important because as a royalty company, maintaining discipline on the cost side is pretty fundamental.
Okay, well, I know that many people don't know that royalty companies could have 10 employees, 8, 12, depending on the size of the royalty. So the productivity is much higher than Nasdaq index or most of the tech companies. So people, when look at the numbers, they say, "Wow, I can understand that why the EBITDA margin is 60% or 70%." So okay,
80 to 90%, right? I mean, generally speaking, the biggest royalty company, if you forgive me for interrupting, but it's an interesting point. A $30 billion royalty company is something like 30 to 40 employees. So, the business model is incredibly scalable. And that's actually one of the really nice attractions of the royalty model, in that as we add assets to our royalty portfolio, they're not accompanied by the commensurate cost increase that folks would expect in an operating business.
Okay, great. So last year, also the company changed the name because before the name was Anglo-Pacific. So if we look at 2014, for example, this company was focused on coal. So could you explain the history of Anglo-Pacific and when this transition starts to be real? So could you explain the last 10, 15 years, please?
Sure. So Anglo-Pacific as a vehicle has existed for quite some time. And as a vehicle, really it seemed to adopt the royalty strategy at the core of its portfolio, sort of in the 2000 to 2010 range. There's a change in senior executive leadership in 2013, where Julian Traeger was appointed CEO of the company. And at that point, the strategy was to focus much more on royalties. In the past, prior to that, there had been both an equity strategy and a royalty strategy. And then in 2014, the business faced a few strategic challenges. So the first strategic challenge related to concentration risk on a single royalty. So in other words, the bulk of the group's cash flows were tied to one asset and one commodity. And a second key strategic issue was that asset in sort of 2026 would no longer be producing material income as mining operations moved out of the group's royalty areas. So the strategy at that point was really focused on, number one, building a base of royalty income to replace, on sort of a 1-to-1 part, roughly speaking, the legacy source of income, which is primarily derived from one royalty in our portfolio, Kestrel, which, as I mentioned, will be running off in 2026. And the second was to pivot the commodity exposure. And we've effectively, having done that, having changed this business, which was almost at one point 100% coal exposure, to today by asset value, approximately sort of 70 to 80% base metals, so copper, cobalt, nickel, plus uranium, vanadium. It just felt like the right time to change the company's name, because the company had changed so much from what it was previously as Anglo-Pacific to what it is today as Ecora.
Okay. If I have to resume the main strategy for the next 3, 5, 10 years for your company, is it fair to say that you want to be the biggest metal industrial royalty company in the world? That's the main goal?
As of today, where we sit, by as a percentage of our asset base, we're probably offering investors the largest exposure to a basket of commodities which are really required for the energy transition, specifically copper, nickel, cobalt, uranium, and vanadium. And our strategy from here is to just doing more of the same, actually, because as we think, what's the opportunity for this company? Well, it's a very simple answer. There are not that many, well, there are no royalty companies today of scale and size that offer investors de-risked exposure to this basket of commodities with all the benefits of the royalty model. There are a lot of very large royalty companies primarily focused on precious metals or iron ore, but less so in our basket. And therefore, as we continue to grow, we feel like there's a lot of opportunity to position this company as one which appeals to individuals or fund managers who would like exposure to the energy transition thematic while benefiting from the virtues and the de-risked nature, relatively speaking, of the royalty model relative to investing directly into mining equities.
I'm one of them, right? Because I don't like the mining companies for the operating leverage, because when the cycle goes well, it's amazing. But when it rears, you have the decrease from the price, from the commodity, but at the same time, when revenues decrease 20%, your EBIT decrease 80%. So if you want to explain a little bit, this slide that I think it's interesting. So here are the main application for the future linked to the electric vehicle, but also the batteries, power generation. So could you explain a little bit all the verticals that you want to be in the future?
Yeah, this really comes down to the core of what investors can expect in terms of the trends or the end market exposure that this basket provides. And it's actually, we think about it as being quite a bit broader than just batteries per se or electric vehicles, because the trend of decarbonization really starts with, number one, just producing renewable energy in a more sustainable way. And renewable energy is much more metal intensive, relatively speaking, than coal-fired power or natural gas fire. So in other words, to build one wind turbine and replace, not let alone expand production capacity in terms of energy, requires a lot of metal. It requires a lot of copper. Wind turbines require a lot of steel. And the next real leg of exposure is to actually just transmitting that energy, because the grids today are not equipped to deal with energy demand that would likely be, the energy demand implied by a net zero future. So a lot of investment is required into power grids just to transmit the power from renewable energy to homes or to industries or businesses and so forth. And within that thematic, there's another subset of commodities that we have exposure to, but we also target generally. Then the next one, of course, is just the storage and consumption of that energy. So all else being equal, an electric vehicle is just much more metal intensive than a combustion engine vehicle. And as we continue to swap the fleet away from combustion engines towards electric vehicles and hybrids for that matter, there's just a natural demand pull. So across this thematic, which is really the electrification thematic, the reality is the electrification thematic is entirely aligned with a substantial demand in metal and metal intensity of usage. And the last thing we really look for when we deploy capital is operations that themselves are greener or cleaner or have more relatively very attractive carbon footprints. And there's two reasons for that. First of all, because there's a virtuous and moral reason, i.e. in the mining sector, like all industries, we have a responsibility to consider the impact of climate change and environmental consideration and so forth when we deploy capital. But number two, there's also a very strong economic argument. What we've already seen, and we're likely to see more of it, is that the greener and cleaner mining operations or productions get better prices. We've seen it in copper. We see it today in iron ore. So if you have a cleaner, greener product, actually, it's likely that the operation will do well. because you get better prices. And for as a royalty company, that's really important. Our big risk is that the mine stops producing. And so therefore, when we think about the asset-specific considerations, it effectively is part of our diligence and our objective to acquire royalties over assets that are relatively low cost and that can withstand the volatility that exists in the mining sector, or in other words, able to generate cash flows through cycle.
Do you have any internal target for the future in terms of mixed commodity? So I want to be 40% revenue copper, I want to be 20% revenue cobalt. So do you have some target like this, or you try to search for the best opportunities in any time?
Yeah, I think what we've managed to achieve to date is a bulk of our portfolio commodity exposure to base metals. It's primarily copper and nickel. And that's a very hard thing to do, actually. So it's much harder to get that exposure than to say we will get it in the market. We like having Ecora in our portfolio of copper and nickel, number one, because the demand outlook appears very compelling. Number two, though, these commodities have a very diversified usage within these four thematics as illustrated on the left-hand side of the page. Beyond that, generally speaking, there's a slide in the presentation which includes all the commodities that we look at as part of our remit. Well, let me correct that. It includes other commodities that we consider within that remit, which includes things like lithium, zinc, manganese, graphite, tin, rare earths. So there are other commodities that aren't part of our portfolio today that we certainly consider as part of, coming back to the point I made earlier, that we're really looking to position Ecora as kind of the one-stop shop for someone who wants this exposure, who says, I would like exposure to this thematic. Can I go somewhere and get it all in one place? And can I benefit by it being a royalty model, which is, again, as you mentioned, has different volatility and different through cycle performance.
Is China the best, the main opportunity, but at the same time the main risk? Because more than 50% of the demand for iron ore and most of the industrial commodities come from China and Asia. So is it the same? I understand that for copper, nickel, and this kind of metals.
Well, it's an interesting question, because if you think about commodity demand over the last decade, a lot of that story, the incremental and commodity demand growth, was tied to a trend towards urbanization. And over the next 2 decades, it's likely that will change. And it really is a function of the metal intensity of the energy transition thematic. And so obviously this is not something that happens overnight. But as you look forward into the future over the next decade, 2 decades, and even within smaller periods, increasingly these metals and the demand for these metals is less of a China play and more of an energy transition play.
Okay, and do you have information about the targets for energy transition? For example, in the European Union, they have a target for 2013, that I think 50% of the cars should be electrical, and I think at 2015, 90% of the new cell cars should be electrical. So do you think that we are in a good way to reach these targets, or maybe we can reach these targets at 2030? So we have to delay these targets. What's your feeling about that?
I mean, look, a 2050 net zero has its challenges. I mean, the reality is when you think about just how many more minerals need to be extracted in addition to what's produced today to achieve 2050, it's both an opportunity, but also an incredible challenge. You're sort of thinking about producing multiples of in 20 years, building new mining capacity that's multiples of all the installed capacity today in the world. And we know that in mining, building in the mining sector, putting the process to agree a new mine with governments, communities, permitting, generally speaking, a new mine from exploration to first production can be in the range of 20 to 30 years. So as a sector, the sector is not one that's, by virtue of its capital intensity, as quick to respond to demand forces as other sectors, where it's much easier to ramp up supply, so to speak. So what's likely to happen is that commodity prices will need to increase to levels that incentivizes a lot of new production and quickly. And for us, that's really an opportunity as Ecora, when that the world today faces its challenges, and many of those challenges are more short-term in nature and thus get more airtime relative to what are expected to be fairly substantial supply deficits across commodity complexes. Therefore, the more we can sort of deploy into this sector today, the more we can position our portfolio in terms of exposure to really high quality assets for these trends over the next decades, which is what we think about as a royalty company, because ultimately we're taking 20 to 30-year views on mining investments. We feel like it's an incredible opportunity to position this business to what could be one of the biggest economic drivers of the century.
Okay, next question is related to your asset base. So in this slide, we can see that 80% of the metals for the future should be industrial metals out of the coal, right? Geographic exposure is tier 1 places. So is it possible that if you have a good deal in a place out of tier 1, you are dealing for that asset, or you are not you don't want to be out of OCDE and tier 1 places?
Yeah, so today we've been able to build our portfolio and to acquire royalties over target commodities for really good quality projects in great jurisdictions. And so we really haven't had the need, so to speak, to consider jurisdictions that are slightly less established from a mining perspective. I think that being said, there are certain commodities where actually you're probably better off in terms of getting exposure to really world-class projects, thinking outside of, say, North America, South America, and Australia. Rare earths being a good example, vanadium to a degree, where it actually makes sense to get exposure to the best quality project, not necessarily being really limiting oneself to OECD jurisdictions. But ultimately, as a royalty investor, the model really relies on the fact that you have an enforceable contract against the owner of the mine. And so if there's uncertainty that that mining operator will be the ultimate owner of that mining concession, there's uncertainty that the royalty may not be enforceable in a court of law, we do think very, very carefully about managing that risk, and therefore about which countries and what sort of geographic risk profile we take. But the reality is, to date, we've had a lot of success doing it in jurisdictions that are OECD. Our portfolio is almost 90% OECD, and if you overlay Brazil, which is a very well-established mining jurisdiction, now it's 100%. So the geographic footprint today doesn't leave much to be desired.
Some people say that when you go out of tier 1 and you look at Nigeria, Africa, you have geopolitical risk, execution risk. But for example, in the gas and the petrol market, so you can see that the UK and the Dutch, they changed the regulation and they tax a lot companies, upstream companies in gas and petrol. So do you think this is the best countries to be, but at this time not in Europe, right? Okay, let's explain your main assets under production. So just a little bit about your assets, why these assets and why not. So could you explain a little bit?
Yeah, I'd be delighted to. So the first thing really that one should be aware of when looking at our asset base is that while Ecora Resources itself is a sort of mid-sized, mid-cap company, the counterparties, for the most part in our portfolio, i.e. the assets, are really run by very well-established medium or mega-cap businesses. So one of our biggest assets is exposure to a Vale mine in Canada. Vale is one of the world's largest mining companies and one of the best operators. Our copper exposure, in part in Chile, that we have is with a group called Capstone Copper. The CEO there, John McKenzie, has an incredible amount of experience operating in South America. Previously was with a group called Audley Capital, and when some of these assets were privately run, and before that with Anglo American working in and around South America. Our exposure on the iron ore side indirectly is operated by Rio Tinto. Our vanadium exposure in Brazil is a group called Largo Resources. Largo Resources, according to Wood Mackenzie, operates the world's lowest cost vanadium mine in Brazil. On the uranium side, on the producing, again, we have exposure to the Cigar Lake mine by a McLean Lake Mill toll milling agreement. That operation is run by Cameco. I mean, Cameco is one of the world's largest and well-reputed uranium miners. So it's not, I mean, these are very good counterparties. Our coal asset is run by a group called Adaro and EMR Capital. That royalty will run its course in a couple of years. And then turning to the development portfolio on the next page, which we think is equally exciting, if not more exciting even. Our West Musgraves royalty is now owned and operated. That project is now owned and operated by BHP, which is the world's largest mining company. That's one of our flagship growth projects. It's a copper nickel project being built currently in Australia. We also have exposure to a really exciting project at Santo Domingo, which has really a completely different, the project is so different as in the context of it being considered Santo Domingo Manto Verde. In other words, it's part of a copper district owned and operated by primarily Capstone Copper. In Brazil, we also have a very exciting growth asset in a project called Piauí, which is owned by Brazilian Nickel. This is a copper nickel royalty. That group is currently in the process of seeking to target to complete construction financing. So those are really the big ones. And if you add all that together, there's a slide, if you would, which show this one here, which just gives you a feel for how the portfolio is positioned to grow in the future, and how it looks kind of relative to where it was previously with Kestrel. So I mean, these are all broker forecasts at the end of the day. These are not Ecora forecasts, these are broker forecasts. And so these will go up or down, of course, depending on broker commodity price estimates. But what this slide, I think, illustrates is two things. Number one, our current portfolio, over the next decade, it's expected to largely replace the income from Kestrel, which is the royalty that will run off in 2026. And then beyond that, in terms of projects that are both in construction or very close to construction, the business has a path to over $100 million of royalty income, which is derived from commodities that themselves has exceptionally strong fundamentals. So when we think back, when I look at this slide today, and I think about what this looked like 10 years ago almost, currently most of this is all new. This is all the fruits of our labor, so to speak. In that 10 years ago, it was just Kestrel and there was really nothing on the right-hand side of the page. So we couldn't be happier with where the business is today from a bottom-up perspective. In other words, we've assembled a portfolio of primarily tier 1 royalties with really strong counterparties in established mining jurisdictions, with a path to substantial revenue growth in the medium term, and then beyond that, with a lot more organic growth upside. And furthermore, of course, our job is to evaluate royalty deals, so we're always looking to grow the company even further.
Okay, I was checking last week all your agreements in terms of it is a royalty, is it a stream, and if I'm fair, I think that all of the agreements was a net smelter return, or they are GGR, so production or sales. So you don't have any agreement related to NPI, right? Related to net profit. Is it fair?
Right. We have NSR exposures and stream exposure.
So
we also have gross revenue royalties, but these are in commodities where an NSR is not appropriate. So I'll give you an example. An NSR stands for net smelter return, which makes sense if it's a copper project because the copper units go to a smelter and refinery. And if you have a commodity which isn't subject to that process, so to give you an example, vanadium. Generally, these royalties tend to be more linked just to the revenue, or another one is cobalt, right? Although it's a stream, but there are certain commodities which are generally structured as gross revenue, which effectively are the same as a net smelter royalty. What you've identified as a net profit interest royalty is very different. And this is a right to a percentage of income after operating costs are typically deducted, after capital costs are typically deducted, after financing costs and so forth, which is a much more equity-like investment. It's very different to a top-line exposure.
I'm asking this because sometimes when I'm researching royalties, I can see that some royalties that they have agreements related to NPA, and I don't understand that, because if you are a royalty, you don't want to be a mine operator, right? So an NPA is the same than a mine, because you are supporting the sales, but at the same time the OPEX, no, the cost. So okay, just to be clear about that. Let me ask you about your guidance. So your idea is to try to reach in 2026 100 million revenue in industrial metals out of cool royalties, right? So this is your main target, right?
Well, not quite. So what we have in the portfolio today, if you were to just again look at broker forecasts, if you could please just go back to the slide we were on. The portfolio from producing assets is expected to generate something in the range of, call it $55 million if you assume broker forecast today.
Mm-hmm.
And then beyond that, the portfolio is expected to see the West Musgraves royalty come online, which is in construction, and that's targeted for first production in 2025. The POE project is targeted for first production in 2026. And currently, the Santo Domingo project is targeted for first production from between 26 to 28. So I think the 2026 timeline is probably more on the tighter side. As a percentage of revenue, I think by 2026 we should be close to, on the slide here you have it, 90% future-facing commodities, and that excludes iron ore, which actually you could actually make the argument that really high-quality iron ore in the form that we have, which is pellets. Iron ore pellets is a really important component in terms of achieving decarbonization of steel. So you could make the argument that that number is probably closer to 100%, but we haven't done that.
Okay. Could you explain a little bit your strategy in terms of capital allocation? So in this slide, we can see from 2014 to 2021, your acquisitions. And then at the right, we can see the price that you pay and some consensus NAV, so some estimation about the net asset value of these assets and the income that you are accumulating from today from when you bought. So could you explain a little bit your strategy, how you finance the deal? So you are using equity, debt, a mix of both. So what's the strategy here?
And we'll start with the second part because that's probably a bit quicker. So in terms of our financing strategy, the company has really grown, as you can see on the left-hand side of this slide, in terms of its revenues over the last 9 years. And the consequence is that the business's debt capacity has grown substantially. So in 2014, the business's debt capacity in a revolving credit facility to finance new acquisitions was fairly de minimis. And that's grown from sort of zero, if you go back to 2010, in terms of a revolving credit facility, to today, 200 million, inclusive of an accordion that we have in place to fund further growth. Over that period of time, we continue to consider funding acquisitions, if they're meaningful of scale with equity. Although the business today has the capacity to acquire many royalties without issuing equity. Excuse me. What we have here on the right-hand side of the page is, in some ways, a bit of a mark-to-market in terms of evaluating our capital deployment. So what you can see is a number of royalties that we've acquired. You can see the acquisition price. And then the next column shows what brokers estimate is the market value of the royalty today, based on discounted future cash flows expected to be generated from the royalty. And the next column is cumulative income. So if you add up consensus NAV and cumulative income, very simplistically, what you see here is a total return metric, which, in our view is good, but really it's for investors to decide if they agree. In any event, we've presented it in a fairly transparent way. And I think what this shows is really two things. Number one, because we don't focus on a single commodity, what we're able to do is move between commodities, so if copper is expensive, we look at doing nickel deals if it's cheaper, and so forth. And it's allowed us to have good entry points, and therefore through cycle, the royalties have performed well. And I think number two, it goes to show that the royalty model generally offers a lot of upside, and that as a royalty investor, royalty companies often benefit from life of mine extensions, production upside, and so forth, which isn't always priced into royalty acquisitions, the consideration paid.
Okay, great. So right now you have more or less 100 million revolving credit for potential new acquisitions. So you have 35 million net debt. This is at the end of 22. Let me search for one slide here. So at the end of 2022, so cool assets, Kestrel means the main royalty stream. So when I was talking with Jeff, the IR, investor relation, I said, why you are not hedging the cool exposure, because the prices remain high, not too much higher than last month, but is it an option, or you are definitely not thinking about that?
Yeah, well, there's a few things. Ultimately, hedging in the mining sector is the forward curve is different by commodity. So there are very liquid commodity hedging curves in copper and LME metals, and as you move down from commodities that have public sort of liquid exchange traded prices, hedging is less practical and is actually quite costly. I think the second point is, as a royalty company, I think our investors don't expect us to sort of pick when is the right time to hedge. What many of us tell us is they want exposure to the price pass through of that commodity. And invariably, as you looked up the run in coking coal prices went from something like $100 per ton to their very peak last year of around 600. And so therefore, to speculate on commodity prices in the short term is not really our business model. Our area of competence is mining diligence, i.e. picking good projects. And our area of of expertise is also in deploying capital to longer term trends. So generally speaking, it's quite unusual for royalty companies to hedge either at top or low prices.
So I think you are so positive about the prices for the future, because as you know, the demand for these new electric vehicles, batteries, and things, they have to press the price to the up. No, this is the main rationale here, right, Marc?
Yeah, well, I think it depends on your horizon, of course, right? But if you look at the horizon and the outlook purely for copper, and if you look at copper on a 3-month view, 12-month view, 10-year view, 20-year view, why you would want to hedge is if you just think about supply-demand balances, hedging in copper is potentially unwise, just given what are some really attractive fundamental trends, right? As I mentioned earlier, copper markets are expected to move into periods of prolonged deficits. And so part of the reason for, I think, folks who want exposure to Ecora is if they fundamentally are equally as constructive on the outlook of these commodities and want to have unfettered upside risk exposure to a basket of commodities that are expected to perform exceptionally well.
Okay. Before moving to questions from the people, so I like this slide because you think, okay, so my goal in the midterm, in the next 3-5 years, is to try to reach higher multiplies, maybe not than Franco-Nevada and Wheaton metals, but maybe average. So this slide compares Ecora resources with other metal royalty companies, with blue here in the middle, and then with precious metals with the large and the tier ones. So right now you are trading at 0.6 net asset value or book value, if you look at. So what do you think? How do you feel that the investor is feeling your company right now? So they don't understand the company. They don't understand this change from coal to new metals. What's your feeling about the environment right now?
Yeah, where we sit today, I think number one, from a trading multiples perspective in the short term, the business just trades at a discount to peers, and part of that could be the fact that a lot of the short-term cash flows are tied to metallurgical coal. And what you see in sort of publicly traded equities is that metallurgical businesses and sort of mining companies generally don't trade or trade at a discount to, say, base metals companies. So part of that reason is probably a function of the composition of the cash flows of the company in the very, very short term. As we mentioned earlier on that slide, which showed the expected contribution from the commodities, by 2026, this is expected to be materially zero coal. So that's sort of the first point. And generally speaking, one would expect, although this is uncertain, we'll have to see, but one would expect Ecora to have multiples when the majority of its cash flows are tied to base metals. I would have thought that, you know, where base metals royalty by the mining companies at a minimum is a good indicator of where Ecora could be trading. But Altius Royalty Corp is a very good example of one of our peers, which is arguably the most similar in terms of commodity exposure, although not directly comparable. And you know, there's some pretty substantial value differentials between ourselves and Altius. And so one doesn't necessarily need to take a view that Ecora would or even should trade like Franco-Nevada to see that there's a lot of potential in this company for a re-rating over the coming years as the complexion of the portfolio moves away from metallurgical coal and really into what is, you know, the future of the company, energy transition related commodities.
So here, so I was thinking about the main possible risk here, and I said maybe the market is thinking that if there are a recession, the demand for the industrial metals should be go down. So that's possible, right? So maybe this could be one. And the second one could be, so right now, if you look at the balance sheet, the cool assets mean a huge valuation, right? No, and they are fair value. So if the prices continue to be down, maybe you should to adjust these prices, no, with a low level of prices. So do you think this could be the main risk right now?
Well, I don't think that anyone was really assuming that metallurgical prices would stay at the levels, you know, and broker commodity forecasts and the street was not expecting met coal prices this year or next year to be $400 or $500 where they were last year, at 600 even at their peaks. So that's probably part of it. I do think, though, generally, you know, what we've seen is, you're absolutely correct. There has been a pullback in sort of the valuation of mining sector, mining equities as part of some bigger macro concerns. And so, you know, to understand Ecora, there's two approaches. One is sort of a top-down approach, which is more linked to what are more short-term structural trends, or well, more short-term structural challenges, I should say, in terms of the U.S. debt ceiling issues, you know, more global geopolitical events. And then there's more of the alternative way to look at it is a bottom-up, right? Which is to look at the company's growth profile, to look at the company's development assets, what our view is very high quality development assets and very strong counterparties. And in that regard, it's kind of perplexing, you know, to see the business trade where it is today. But you know, short-term market fluctuations are part of the norm. You know, these things happen. But the business is trading at levels which offer a relatively really attractive entry points compared to not only royalty companies but even mining equities.
Okay. Are you active in terms of marketing, for example, traveling to the US, explaining the history to fund managers? So are you doing that?
Yeah, that's another reason, actually. It's a good one because the company has changed, right? This company 5 years ago, and the type of people who are interested in what was Anglo-Pacific then, were people who, you know, understood primarily one metallurgical coal royalty and met coal, right? The company today is very, very different. And therefore the audience and those who are interested in Ecora tends to be a different set of investors, and both institutional and non-institutional. So there's a lot of work to be done in terms of telling folks about what Ecora is today, and what I think personally is a fantastic way of getting exposure to the energy transition thematic.
Okay, let's go with questions. Jose Aranda is asking, which one is the biggest risk of a royalty company? The price of the metals? What do you think is the main risk about here?
Yeah, so with a royalty, right, at the end of the day, with a royalty instrument, what you have, the risk you're taking is that production won't happen. And production could not happen for a variety of reasons. One of the
delays. No? So you're talking about delays, right?
Right, so it's delays, but once a project is in production, then will it keep operating for its reserve-based mine life and beyond? And usually that's a function of cost profile. So as a royalty company, I mean, we spend a lot of time, and we really seek to acquire exposure to low-cost assets, because the biggest risk for a royalty is that either that it just never comes into production because the mining operation is not economic, or if it's in production already, that it stops producing earlier than anticipated. So that's a big risk. Now that is a function primarily also of price and volumes, but by positioning our exposure to assets that are relatively to assets that have relatively strong margins, that's how we manage that risk, which is one I would encourage any investor who's considering a royalty investment to really evaluate the cost profile of the mines underlying the royalties, which will shed quite a lot of insight into, as you mentioned, will the asset come into production and when, and number two, will it stay in production?
We have a second question. I think it's interesting. So what can Ecora offer in terms of better deals, better pricings than competitors? What do you think, which could be the difference from Ecora than other similar companies?
Yeah, the first point to make is there are just not that many companies seeking to do what we're doing. There are a lot of royalty companies, yes. There are very few companies specifically focused on our commodity set. And so generally speaking, in the past, almost all of our acquisitions have been bilateral. In other words, negotiated directly between us and the owner of the royalty or a mining company, which is very different to the competitive dynamic that exists in precious metals, just because there are more precious metals royalty companies out there. I think the second big sort of value add source is just our experience and track record. It's up to investors to decide whether they like it or not. But at a minimum, folks can look to see what has Ecora done for 10 years. Have they done what they said they would? We think the answer to that is yes. But in any event, we think there's a really good track record of acquiring really high quality royalty assets and growing the company. And then number three, of course, is just the fact that we've been doing this for so long is quite helpful, because royalty and streaming in large part is about having relationships. And we've been quite patient with opportunities in the past where we track we in the commodities we like, we track the projects we like, we speak with management teams, and not every one of those ultimately leads to a transaction. But when a transaction is there as possible, we're ready. And if you're waiting until the mining company is calling a royalty company or other sources of capital, it's sometimes too late. So just general sector relationships are really crucial and fundamental to being successful in growing a royalty portfolio.
Here we have another question from Leonardo Matamoros, who is talking: who is most important, to be the first in the mining asset, or to be the better company when you offer deals? So, or is a mix of both?
So can you just repeat the question, please? I'm not quite sure I tracked that.
So I suppose that there are assets that all the royalty companies they try to deal for these assets. So sometimes to be the first could be an advantage, right? But so you have to be the first, but at the same time your deal should be to be competitive. So how you mix with the competition for the best deals and at the same time offer the best price? So I think this is not easy, right?
Yeah, that really comes down to the track record, I think, and folks can take a view on whether they like how we've deployed capital or not by virtue of the transactions we've done. I mean, we're really proud of the royalty portfolio we built. At West Musgraves, for example, one of the projects I mentioned earlier, it's in construction. It was owned previously by a company called Oz Minerals. Oz Minerals had a really strong track record as a mining company. And we've gone from excellent to phenomenal in terms of that counterparty now being BHP. To my knowledge, there's only one royalty, copper royalty of size, of scale, on a BHP project in Australia, and we own it. Those types of royalties are very, very rare. So it's not as though there are, if you miss deals, the deals, in other words, the royalties that we've acquired in the past 10 years, it'll be very difficult, we think, for our competitors to overnight go acquire equivalent quality, just because that doesn't, it's not, there are only so many of these types of, it's a limited availability of these royalties.
Okay. Last question, Camilo Mesa is asking about, there are any litigations with governments, communities, in any place, in any asset that you have a royalties stream?
Yeah, not materially to my knowledge. Most of the assets are, well, the bulk of the NAV of this company today is tied to assets that are in production. So to my knowledge, there are not sort of material litigations or loss of licenses and pending. That would be announceable for our royalty companies or the mining companies. And in relation to the development assets, well, ultimately, many of these development assets are always subject to a permitting timeline. But the ones that we've mentioned appear to be very well advanced. We are not exposed to any assets that are currently the subject of expropriation or that have lost mining licenses as a result of poor environmental practices in the past or anything along those lines.
Okay, great. Marc, if you want to finish, if you want to add some words as a summary for this 1 hour interview, so what do you want to say?
Well, I would just thank you for the opportunity to sort of to speak about Ecora. We personally, as executives, but everyone in the company is really excited about the opportunity that we have ahead of ourselves. And we think about how far and how much the company has actually changed in the past 10 years, and we think about what we hope to accomplish in the next decade. It's just very exciting. We're really happy with the assets that we have and the quality that we've assembled. And so therefore, we see it really as a matter of continuing to execute successfully. I think we've proven that this model can work. We just need to keep doing it.
Okay, I'm happy if I can help you the company to be more visible in Spain and also in Latin America, because more or less 30% of the people that connects to the channel was from Latin America. So it could be a good opportunity to explain the idea, right?
I'm delighted, because actually a lot of our assets are in Latin America. And so for folks who understand mining in Latin America, exposure to Largo in Brazil, Piauí in Brazil, exposure to our Chilean assets and Peru actually as well. These assets are generally more well understood even in those parts of the world than in London. So we're delighted to reach your audience.
Okay, so thank you. So we are in contact. So we are waiting for next developments on the company, and maybe next year if you want to come again, so we can refresh the idea to the people. So Marc, thank you for this interview.
Yeah, it was a pleasure. Thank you so much for hosting me today.
Okay, bye.
Bye.
Bueno, pues hemos tenido entrevista, estaba pactado 1 hora, son 58, perfecto. Aparte, a las 8 hay clase del curso avanzado, por tanto, lo vamos a dejar aquí. Espero que os haya gustado. Ya sabéis que el día 6, los que estéis dentro del club, pues vamos a hacer la tesis de inversión de Ecora. Va a estar muy, muy interesante. Evidentemente, una parte de la tesis es escuchar al management, hacer los números, pero otra parte es tratar de contrastar esa información, porque yo no soy geólogo. Entonces, lo que estoy haciendo es hablar con gente especializada, geólogos, empleados en diferentes activos, y eso nos puede aportar valor a la hora de plantear la tesis. Ya veréis que a la hora de plantear la tesis, los que venís del curso, como ya hemos hablado de royalties, ya lo hemos tratado, pues vais a entender mejor la valoración, pero vais a ver que la valoración es completamente o muy diferente a la valoración de otras compañías. Eso es importante, eso lo veremos dentro del club de inversión. La idea del club de inversión es, primero, que sea un foro o un sitio donde sea una continuidad de los cursos, por tanto, sea educativo. Y a la vez, ¿por qué no? Pues poder encontrar buenas ideas de inversión, pero no solo en compañías quality y compounders, sino en cualquier oportunidad que pueda existir en el mercado. Y Ecora Resources, cotizando a un precio de valores de price to NAV o price to book value cercano a los 0,6 veces, pues parece interesante. Ya sabéis que me gusta fijarme siempre en el escenario negativo para tratar de tener margen de seguridad y minimizar pues posibles caídas en la cotización. Ejemplos muchísimos hemos hecho en el canal. No siempre es posible hacer eso, pero siempre mi intención es esa y lo he plasmado con vídeos como en Nagarro, como en GoEasy, como otras compañías, como en Exatronic, que hicimos la tesis el otro día planteando un escenario pesimista en torno a los 60, 70 coronas suecas. Pues eso es lo que vamos a plantear en Ecora, dado que para no perder dinero en una inversión, lo primero que tiene que hacer una persona es pensar en los riesgos antes de pensar en el potencial, ¿vale? Por tanto, os dejo porque, repito, tengo curso ahora a las 8, así que nos veremos probablemente el próximo jueves a la hora habitual de los directos y probablemente haremos un repaso macro que me lo han estado pidiendo. En el canal en directo ya no vamos a hablar de tesis en detalle, vamos a hablar de ideas, pero no en detalle. Todo esto pasa al club de inversión, por tanto, el que quiera seguir viendo todo lo que hacíamos antes en el canal tendrá que suscribirse al club, ¿vale? Al final, pues hacer esas tesis lleva trabajo, por tanto, no es posible hacer ese tipo de contenido de forma indefinida en directo y en abierto. Por tanto, en el canal hablaremos de ideas, hablaremos de macro, haremos entrevistas, muchas cosas, pero las cosas en detalle, repito, pasarán al club. Luis, gracias. Leonardo, gracias. Camilo, gracias. Luis Mayor, gracias. Lo dicho, los que seáis alumnos, conectaros ahora a GoToWebinar y empezamos el curso. Un saludo, buenas tardes, nos vemos el próximo jueves.